Hello everyone and welcome back to my channel. Today I'm going to show you how to find high probability swing trade ideas using ICT concepts. I'm going to give you my process for looking for setups, the strategy I use, and how I manage the trades. This lesson is going to be purely practical. I'll explain how to swing trade using a live trade example that I have recently taken. This ensures that I am not using hindsight examples for teaching. In fact, the techniques I'm presenting here are the ones I actively employ in my own trades. Additionally, I'm excited to announce that I'll be selecting 3 lucky winners to receive a 10k challenge account from a funded engineer. So stay tuned and don't forget to like and subscribe to the channel so you won't miss any upcoming videos. And let's start with choosing 3 winners to get a free 10k challenge account. And here I have all the participants and let's start. So the first winner is, we have an empty space. All right, let's start again. So the first winner is Anthony, I don't know how to pronounce this. So please contact me on my Twitter account and I will reply to your comment so you get notified. So this is the first winner. Now the second winner is Freddy Rick Sorio. Please contact me on my Twitter account. And the last winner is I don't know how to pronounce this, but I will find you in the comment section and reply to you so you get notified. So here's the 3 winners, and now let's continue with our lesson. Now, for swing trading, you will need 3 time frames, 3 essential time frames. The first group of time frames is the weekly and the monthly. The weekly and the monthly is for buys. So where do you want the price to go? That is your buys. We get that from the weekly time frame. The second time frame is the daily, all right? The daily time frame and the 4-hour time frame, we use that as confirmation. So we confirm our buys using those 2 time frames. And you can enter from the 1 hour or the confirmation time frame, which is the 4-hour. Now let's start with a live example, and we have here crude oil, so the US oil on the weekly time frame. First of all, let me show you the executions and my analysis, so you know that this is not hindsight. I posted that in my Twitter account. So as you can see, I entered here from this fair value gap right here, and I was aiming for this fair value gap. And here is the executions. So I took an entry from here and another one from here. And here is the results. As you can see, price went to that fair value gap. There is the executions. Now let's start with the analysis. So the concept I'm going to use here is internal range liquidity and external range liquidity as always, and high resistance liquidity and low resistance liquidity. That is the only 2 concepts you need to trade in these markets. Pair that with time and you are good to go. Now, I told you that price moves from external range liquidity to internal range liquidity, and from internal range liquidity to external range liquidity. External range liquidity is the swings. So this swing right here, this swing, this is called external range liquidity. This internal range liquidity represented in fair value gaps. So like this. So after price taking external range liquidity, our next target should be internal range liquidity right here. So as you can see, price took external range liquidity, right? And now our next target should be where? Internal range liquidity. So this weekly fair value gap. And you can see that we have also touched this fair value gap. So you can see that we have completely filled this weekly fair value gap. That's another confluence to go to the downside. When price takes external liquidity and internal liquidity on the upside, now you want to target opposing internal or external range liquidity. So this was my bias. Now, after my bias is in check, I don't go to enter on the lower time frames. No, I want for the intermediate time frames to confirm my bias. And here I used the daily time frame. We want to see the daily to shift from bullish, as you can see here, to bearish. And as you can clearly see, we have this market structure shift taking this swing. So I like to use, for market structure shift, I like to use body closure, meaning I want the bodies of the displacement leg to close below this swing right here. That is high probability swing. And as you can see, we return to a premium of this leg, right, above the 50%. And now we should look for entries. So the weekly is bearish. We have the bias bearish from the weekly. The daily is confirming our bias to go lower. And we have also from the concept of from the concept of high resistance and low resistance liquidity, you can see that we are creating low resistance liquidity, failed swing. So low resistance liquidity are represented with failed swings. High resistance liquidity are represented with rates. So when price rates a swing and then immediately reject. For example, this one right here. Let's zoom in now and look for entries. So let's go to the 1 hour time frame, and I took my entry on the 1 hour and I was targeting that weekly fair value gap. So since this is a swing trade, I don't really care about refining the entries on the hourly or the 4 hours. So I basically enter whenever I get a chance. So my first entry was somewhere around here. So this is my first entry. It was during the London lunch hour. But I was expecting a rate on this swing right here, this failed swing. So this is lower resistance liquidity, and I was expecting a rate on both of them. And then we create high resistance liquidity. So I put my limit order right here. This was a soup entry. And remember, this rectangle is a daily fair value gap. So I put another limit order right here, sell limit, and I got filled. So I entered the first entry from here, the second entry from here. And then price, what do we have here? A nice market structure shift, right? A nice market structure shift. The body is closing below this swing right here. You can take another entry from here, high probability entry for intraday. So your stop loss is here. And you may want to target this low resistance liquidity. This is for intraday trading. For my swing trade, so in fact, I took 3 positions. As you can see, the first position was here and the second position was here. These 2 are swing trades. My stop loss was above that daily displacement. The second trade was intraday. So as you can see, I took the entry from this fair value gap, this hourly fair value gap right here. My stop loss was here, and I was targeting this fair value gap, the low hanging fruit. But our focus for today is swing trading. So my stop loss was around here, right, for swing trading, and I target this weekly fair value gap. Here is the daily, so we have refinement of that weekly fair value gap. And that is basically it, guys. Simple. Nothing is complex about this approach, and I use it every single day on my swing trading and intraday trading. All you have to do is merge a higher time frame. All right, you need to go to the higher time frame and analyze that, and of course use the concept of external and internal liquidity plus the high resistance and the low resistance liquidity. You can go check them out. I have 2 videos talking about them on my channel. And backtest, guys, collect examples as many as you can. Don't just watch this video and go to live charts and try to apply this concept. No, collect examples, take demo trades first, and then try to trade with this in live environment. So I believe we have come to the end of this video. If you have any questions, please DM me on my Twitter account or leave a comment down below and I'll answer you as soon as I can. Happy trading and good luck.